Are you looking to simplify your investments? Check out BMO ETFs. Your asset allocation can have a major impact on whether you will meet your financial goals, so it's no wonder Canadian investors are turning to asset allocation ETFs to complement their portfolios. BMO offers easy-to-use solutions such as the BMO Growth ETF, BMO Balanced ETF, BMO All-Equity ETF, and more. These ETFs invest in a number of underlying index-based ETFs and are rebalanced automatically. What was once a popular mutual fund strategy is now available through an ETF with the introduction of the T6 units. T6 units provide a 6% annual payout on a monthly basis, helping retirees meet their cash flow needs. This is available on their balanced and growth asset allocation ETFs. Regular rebalancing means you can spend less time planning your life and more time living it. Learn more at bmoetfs.com. Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to Loonie Hour, episode 85. As always, joined by the three amigos. We got Keith Dicker, IceCap Asset Management, still wearing the Patagucci here in end of May, and Rich Diaz of Acorn Macro Consulting. Welcome back to the show, gentlemen. Keith, what's going on, buddy? I thought the storms were over.
Yeah, it's still pretty cool here. We have this cold fog bank coming in. It's kind of interesting. Like we're like juniors getting ready for university in the fall. So you start going through all the the university options have already been decided, of course, right? But you start chatting with friends who have kids at other universities, and you hear these little unique stories, and some of them are just like rich stories. They're not good, they're bad, and other stories are really cool. So one of my friends who's talking about he showed me a picture of his kids, and this one kid, his ginger hair, red hair. And I said, "Oh, he's a ginger." And he started laughing. He said, "Yeah." And he's going to Queens. And apparently at Queens, every fall semester, they have the running of the gingers. So every redheaded kid on campus, they actually run through campus. Like it's a big deal.
Are there like three of them that you get paddle boarded or what?
I don't know. I think it's the only group left of humans where you're allowed to
make fun of.
Make fun of them, yeah. Anyway,
I'm surprised that hasn't been canceled yet.
I was gonna say, I'm surprised that hasn't been canceled.
Yeah, and
we're of course canceling
Junior. By the way, Junior won't go to Queens. Do you know why?
He didn't get in.
No, he got in everywhere. It's too close to Ottawa.
Oh, it's the laugh track. We need a laugh track.
Rich, what's going on with you?
Oh man, I've had a lazy week. I've done very little work. I've enjoyed the sunshine in excess. Just been a beautiful week in London, and
riding your bicycle.
It's been riding my bicycle all over town, just having lunches with people and just really sort of enjoying the little spring here. There's no low key nice day in London, man. If the sun comes out for 10 minutes, everyone's outside on a patio having a glass of wine or
slugging back a pint.
Yeah, for sure. That's what it is here. But no, I'm happy. Lots of things going on. Summer's getting better. Days are getting longer. So there you go.
Speaking of slugging back pints, we're still working on the upcoming Vancouver live event. There will be another one this summer. We're just working on the details, so stay tuned for that. But we got a little bit on the housing front.
Woohoo!
I was at I'll start off with a story. I don't know if I can top Keith here, but so a good friend of mine, shout out to Steve Jagger, who runs a company called Addy, which basically is a real estate investment platform. And so he put on an event, about 100 people for basically it was like a Q&A with the BC government housing minister, BC housing minister named Ravi Kalan. So, nice guy. I mean, obviously coming to a real estate type of event, and he's going to get tomatoes thrown at him. So Steve's basically says, "Hey, you have some questions teed up for me, like I'll ask them." So I said, "Well, why don't you ask them that, they're trying to push through all this new rentals, housing supply. We need more supply. I said, ask him if he thinks a 2% cap on rent growth will hinder new rental construction development. Because, you know, if you think about it as you're a developer, I mean, 2% rent growth, your costs, especially in this environment, are going up, I would argue, close to 10% right now a year. And so anyways, so of course, Steve asked the question and he goes, no, there's no correlation between 2% cap on rent growth and the number of new housing units coming to construction. I was in Ottawa chatting with an economist and they presented this paper to me. And I'm kind of like, everyone's kind of like scratching their head. Like, what the hell is this paper? So of course, Mr. Lululemon, Chip Wilson, stands up at the back of the room and he goes, I'd love to see that paper. I bet you that's a popular paper in Venezuela and North Korea. And then walks out of the room.
Oh my God.
It was hilarious, man. Like it's, you know, this billionaire at the back of the room. But no, for those that haven't been following Chip Wilson's story, obviously he's kind of exited Lululemon, but he's been deploying obviously a lot of that cash now into the real estate market. So he's been buying up a lot of land in Vancouver and whatnot. But yeah, he basically was like, yeah, I'm not investing in rental construction in Vancouver. He's actually deploying a lot of it in the US right now, just because. Anyways, so our housing minister and our academics are convinced that by capping rent growth, which is one of the largest components in a developer's pro forma for determining the viability of a project, does not hinder the investment.
It sounds like it might actually exasperate it,
Yes.
make it worse.
Right.
Yes.
Yeah.
Of course. Yeah.
Well, yeah. I mean, if you're trying to incentivize something, obviously you say, well, your profits are going to be capped. Naturally, kind of limits the upside. So you ultimately get less supply. And so this is, you know, the conversation. So if you think about it through a developer's perspective, just to give everyone a quick 101, like, so over the last, 12 to 18 months, you've seen rising costs and the cost of financing, right? To construction financing costs are through the roof. CMHC's rental program, they've increased their development charges. Meanwhile, you've got municipalities have been increasing their development cost charges as well. So all of your costs are basically going up. Yes, your rents are going up, but you obviously, like I said, if you're capped at 2%, you are kind of limiting the upside on the profitability of that project. So it's the risk reward right now is why you're seeing a lot of new housing starting to roll over. So hopefully that gets resolved. But that was kind of part and parcel of my week.
Sorry, is
It's
he
kind
the
of interesting.
MP for? Sorry, can you just remind me what is his job? Sorry,
Who?
this gentleman who thinks that rental growth has nothing to do with supply.
Yeah, Ravi. I honestly, I thought he was, kudos to him for, like I said, sitting in front of a room of basically 100 real estate people and taking some really difficult conversations. But he is the housing minister in BC. So he's responsible for basically implementing housing policies, rent controls, incentivizing new supply, et cetera. He's doing everything. The housing file is his responsibility.
Okay, so I mean, does he have no shame? Is my question, because I mean, if you go, I mean, experts, fine, whatever, but I mean, these are practitioners. These people are like yourself, are in the game every single day, all day, trying to build houses and trying to, justify valuations, trying to raise capital, deploy capital, raise financing, etc. I mean, like I said, does he have no shame? Does he not hear the pushback from these practitioners and say, you know what, maybe I've got this wrong, I should reconsider my position? I mean, does that ever? Am I just very naive about this stuff? I guess. I
think deep down probably, but I think there's the politics of like, oh well, a lot of our voter base might be, renters, and 2% is a good sell for us politically. But like I said, like at the end of the day, you're kind of like hurting those tenants, because at the end of the day, they're going to be left with less options in the near future as, new supply basically gets throttled back. Kudos to him. We did bring up a couple other things, which was, we've talked about on the show, is the rezoning of multifamily, basically allowing duplex, triplex, fourplex on a lot of these lots. So that looks like it's going to be in implementation here in BC towards the fall. And then, so that was, I would say, was one of the big ones. And Yeah, I know we talked a whole bunch of other stuff, but yeah, it's. I mean, the housing file is so political. It's definitely a mess. I don't think it's going to get resolved. It's just too much,
Okay.
too many barriers.
I think Keith was going to ask us a question, but he's on mute.
Yeah, no, I was just talking away and nobody. Felt like I was chatting with Mrs. Icecap sometimes. No, but it's kind of interesting because one thing, you're talking about how, when I hear this story, Steve, I just hear, once again, the public sector or government, they're trying to influence the way capital markets or the private sector should allocate their capital, right? And it's kind of interesting because, I look at what's happening over the UK this week. It wasn't two in the UK and one for Europe or the Eurozone or EU. Right now, Christine Lagarde is combining them all together into one country in her mind. But there were three significant comments and announcements over there this week. And remember, like we like to say all the time, if something's happening over there, it's probably going to happen over here as well. So we'll dive into that as well as we get going, but it's the exact same theme. It's government knows best. And if any government is listening, you don't always know best, not for the private sector. Let us allocate capital the way we want to.
Yeah, no, for sure. I mean, just to kind of add on to the housing file, there was another report from the Bank of Canada last week, which kind of stirred some headlines, which was they put out a research note which suggested that fixed payment variable rate borrowers would need to increase their monthly would need to increase their mortgage payments by approximately 40% in order to maintain their original amortization schedule, assuming a renewal in 2025 or 2026. So the Bank of Canada's research is essentially saying these people that are on these variable rate products where their payments don't really change, if they just leave it as is, they're going to see huge increases in 25, 26. So they're suggesting that you need to increase your payment by about 40% to keep your amortization schedule on track. Now that I think there's a lot of holes in that argument, which I'm sure we can get into, but.
Well, can I just ask a quick question before you go on to that? So is that we talked about, the Great Rate Reset, which is different countries that have very short duration mortgage books. So South Korea, UK, Australia, New Zealand, Canada is obviously one of them. Very much unlike the US. We've talked about how as the rate hikes that we've seen flow through, there's going to be quite, the consumers are going to be squeezed. Does that just mean we're about to see it, or have we exaggerated that point? Have we yet to see it, or do you know what I mean?
I think it's a little bit exaggerated in the fact that it's a potentially larger problem, but I think it's a bit exaggerated to the similar route of the mortgage deferral cliff, which basically means that there's a lot of variables. You're trying to forecast and predict where things are going to be 3 years from now. These guys couldn't predict. I couldn't either, but you couldn't predict rates. These guys couldn't predict transitory inflation, which was screaming at everybody's face when, your M2 growth was up to double digits. So the fact, obviously in their projections, they're projecting who knows, right? I mean, if we stumble into this deep recession, rates go back, maybe not to zero, but they go lower. It's just, and then house prices right now, as of right now, they're going up. So that gives people more equity in their homes, which allows them to basically refi and push back their amortization schedule. So there's so many variables at play that can happen and change this scenario that I think it's there's no sense in losing sleep over something that's 3 years out when we can't predict 3 months out.
Okay.
But yeah, it's sort of this thing that's out there that but I think there's a whole host of scenarios that borrowers are going to figure out, manage. There's definitely going to be some that get left behind. There will be people that lose their homes. It's going to happen. But is it going to be catastrophic? I'm not necessarily convinced, but that's coming from someone that's in the industry.
I have another question because Keith is still frozen or something.
I think Keith is. Are you
I was waiting for a laugh track there. Steve trying to make a real estate kind of a joke, and I was like,
was that?
I never know.
I got no jokes.
Anyways, Okay,
It's
go for it, Keith.
no, I mean, we're barreling like, right down the middle of the highway here towards the next Bank of Canada meeting, whether they're going to hike again or not. And there's lots of data out there to suggest that they will or they should resume hikes. And most importantly, the Aussies have done it. And now other central banks are sort of hinting they might want to start hiking again. But the data is also there to suggest how, that they don't have to. We went through that last week, and we talked about how inflation data is still increasing, but it's at a slower pace, so it is coming down. But this week we're getting the bank's earnings coming out. So we're going to go to the bank's
question,
earnings.
Keith. Did you see New Zealand? I thought it was interesting that they raised rates as they were kind of expected to, but then they're apparently unexpectedly their Bank of New Zealand governor or whatever came out and said that they're done. They're on pause. Kind of shocked the markets a bit.
I didn't see that story. So
I guess that's another one of your central bankers that has kind of moved to the sidelines. So Tiff might not be the only guy, I guess, on the sidelines as of right now.
It's really tough because, what are they going to do? I'm still under the expectation. So if the Twinkie is on the line, and I think we need something different styles of Twinkie, guys. I'm getting a bit too Twinkie on the side here. But I don't.
Yeah, you
I think they're done.
You got to slug a beer back at 8 a.m. in the morning.
We haven't on that before. But yeah, I'm still under the impression that they're on hold. And it's because, again, you go through the whole Twitter world, some people can be a bit living in a different world when they're there. But that's a nice way of saying people can be aggressive in a field that maybe they shouldn't be aggressive in. But with the Bank of Canada, they're looking at all the data. They're just like us all the time. And we had the bank earnings come out this week, yesterday, and again today. Today's Thursday, of course. So I think we had 5 of them have come out. Hit 5 banks or 4? I don't remember now. The last 2 days.
I think all of them. We'll double check. But Keith, walk us through that. So yeah, so you had TD today, CIBC, RBC. I think we have BMO and Scotia yesterday. So yeah, I think we've got all 5.
Yeah, that's all of them. And so as one thing that we've been tracking a lot now over the last maybe 3 quarters is what's happening with the provisioning for credit losses or loan losses. And just for that, if you're not familiar with what that is, let's just say 3 of us here at the Loonie Hour, we are a bank, and say we've lent out $1 billion in loans for people to buy houses, for example. And we think that, hey, you know what, things like the rise in interest rates, it's going to make it difficult for a portion of our customers not to be able to pay back their mortgage. Maybe they'll become delinquent on it, so late paying and stuff like that. So 3 of us, we have to come up with a number. And we'll say, for example, let's just say of that $1 billion that we lent out, let's say, maybe there's $10 million in loans or mortgages that we're not going to get our money back on. So we set that aside for the quarter. We're provisioning for a credit loss. That's what that's called. And as you go from one quarter to the next, you add more money into that. Call it a smoothing account, if you want, something like that. And then say the next quarter and quarter after, the economy recovers again, so you can plow money back out of it. And that's what RBC did back in 2020 or 21. I forget what, it was 21. And so they took about 600 million out of that kitty, and it really boosted their earnings. And now a year later, with their numbers are coming through, they've had to put all that back in and more. So, that's just a bit of a wordy way to explain what's happening here. But now over the last 3 quarters, all of the Canadian banks are increasing their provision for loan losses. So they put in more this quarter than the previous quarter and more before the quarter before that. And in actual fact, RBC, comparing this quarter to the same quarter a year ago, it's almost $1 billion difference. Right, that's a lot of money for anybody in the banking world. So what that means is that we're still going in the direction where the economy is getting softer. It doesn't necessarily mean that the banks have taken these losses yet, but they're preparing for it. And that's what the Bank of Canada is looking at. Remember, they're chatting with the big banks every single day. What are you seeing in this loan market? What are you seeing in your investment portfolio for this side? What can you guys borrow at? And stuff like that. But all five banks, all the five of the big banks in Canada, they are signaling to the Bank of Canada that we're continuing to see our loan portfolios deteriorate. Now, the other thing to think about here is that if you track, for example, these non-performing loans to total loans on your book, and you just want to use RBC as an example, I tweeted it out, so it's just public data, and I'm not implying it's good or bad or great or anything, but the amount of money they've allocated to that smoothing account, the non-performing loan account, relative to their total loans, because that's what to look at, it's at the lowest number in over 20 years. It's extremely low. And this is without a recession here in Canada. So if you look at the same data for TD, BMO, Scotia, and CIBC, you're all seeing that same space. So what we've been suggesting now for a while, and we continue to have this view, if Canada should miraculously return to a normal economic business cycle, right? You mean hit the laugh track, Rich? You hit the button.
Right. Yeah.
Yeah. The opportunity is there for all the banks to more than double the amount that they're putting into this bad loan provisioning account. If you want to call it.
Sorry, just to be clear, sorry to interrupt you, but a low number is a very optimistic view of the world, and a high number in your scenario would be something that would be very conservative, right?
Yeah. So right now, the number is showing that the amount that they put aside for bad loans is giving the impression over the history of this data for any one of the big banks you're looking at. It's the lowest amount on a relative basis they ever put aside. And this is at the exact moment in time we've gone from zero rates to say 5% in Canada. We've yet to hit a recession. We get all, globalized risk has been synchronized. Global risk has been synchronized around the world is what we talk about quite a bit. So again, the banking sector in Canada, it's going to be awesome if nothing happens, if you get a soft landing and all that stuff. However, if we do trip up somehow, because it could come from somewhere else, the banks, you will see the banks really ramping up their loan provisioning very aggressively, right?
Couple notes on that, Keith. There's some interesting comments from Scotiabank in their earnings call. They actually saw their mortgage, I think it was their mortgage balance actually shrunk, outstanding mortgage balance, which is quite unusual, but it actually highlights more so them pulling back on their lending. So for those that aren't deep into the space, during the pandemic boom, I can tell you, from my opinion anyways, that Scotiabank was probably one of the more aggressive lenders. So especially for investors, like if you were an investor and you're picking up rental properties, a lot of those deals would end up on Scotiabank's desk. They would fund them happily. And really, since obviously the housing market has turned, new CEO, et cetera, Scotiabank has really pulled back on that business. I also found it quite interesting that, again, keep in mind, a lot of investors will tend to go variable rate mortgages. And if I mentioned to you that a lot of variable, mortgages are done at Scotia also has what they call is like a floating variable. So it's not one of those fixed payment ones where like Bank of Canada raises 400 basis points and your payment doesn't change. Scotia banks will fluctuate every time the Bank of Canada basically raises interest rates. So you'll have an immediate increase in your monthly mortgage payment. They noted in their conference call that discretionary spending, such as retail spending, entertainment, et cetera, is down 10% year over year for their variable rate mortgage customers. So it kind of shows you that Canadians, obviously, as payments have been increasing on these mortgage interest costs, are cutting back. And so Scotia is seeing clear evidence of that at least on their variable rate mortgage customers.
But that was my point earlier, Steve, which is like, I still, maybe I'm just maybe we disagree, and that's probably a good thing, which is I think that we have yet to see the real pain come through from interest rates and mortgage rates at whatever 5 and 6 or whatever percent. Because if you look at something I look at a lot is debt servicing costs. So household debt service costs, while I look it up quickly, which is basically your household spending as a portion of, I'm screwing this up, sorry. It's proportion of disposable income required to meet debt obligations. And it depends. There's obviously two parts of it. There's like the total debt servicing cost, and then there's the interest component of that debt servicing cost. And that interest component is ripping, and it's already basically at to 10-year high. The total at 14%, whereas other countries like in the US it's much lower. It's at basically historical lows. And so I just think if you do get some kind of downturn, as Keith has talked about many times, in employment or consumer confidence is not doing that well. I just feel like those two things going in opposite directions are gonna really hurt. And then obviously it brings it back to the banks, et cetera, et cetera. But I don't think we can ignore that number.
Yeah, but you're exactly. And so you're talking about like lags. Everyone's like, oh my God, like inflation's coming back. The Bank of Canada needs to keep raising interest rates. Well, like, again, just talking about these lags and how long it takes time to filter through. The Bank of Canada says, again, per their own research, they put this out in their financial stability report like last week, only 1/3 of mortgages in Canada have actually seen an increase in their payments compared to February of 2022. So as they started raising rates, which I think was in March of 2022, that was their first rate hike. Only 1/3 of mortgages have actually seen an increase. Now, again, so keep in mind, like of those 1/3, I bet you there's some people that are just coming off of fixed from 2018. So like they might have come off a 3.5% rate and they might have been able to lock in at 4.2, which isn't like that much damage. And then you've got some of these fixed payment variables, which have only seen maybe marginal increases because of how those programs work. So I think, yes, I would agree with you. I don't think you've seen a lot of this flow through yet on higher interest rates. And remember, they only stopped raising rates, 4 or 5 months ago?
Yeah.
Feels like an eternity. They need to raise rates again, guys.
Did you see? Speaking of which, I was kind of curious, Rich. I don't know if you've done much digging into this. I know you're the data guy here, but what's your read on this trueflation? I guess it's a free metric that's tracked online. It was going around Twitter basically because I think they had U.S. trueflation. They had it pinned at, I think, 2.98% year over year. So they're basically having U.S. inflation is now, according to their metrics, sub 3%. And so people were kind of like, hey, like maybe we should take this, because I think like obviously there's a lot of debate, especially on the internet, around is the government massaging CPI indexes? It hasn't been reporting true inflation for the last decade. And so trueflation, I think at one point hit 12 or 13% year over year. So it's higher than obviously the official CPI basket. And now it's showing movement to the downside of under 3%.
Yeah, I mean, I've looked at this. I'm always really skeptical of people who think they can reinvent the wheel. There have been other ones. I think that there was now the company's escaping me basically, but they basically used the basket, the CPI basket from 1980s, and they calculated the CPI from I think it's Shadow Stats. I think that's it. Shadow Stats CPI or whatever. I remember now. And they basically used the CPI basket from the 1980s or 1990s, and they calculated inflation based on that basket. And they said, see, inflation's much, much higher. It's always been much higher. I mean, I think it's kind of a bit of a red herring because I remember when we first started doing the podcast, we would talk about the inflation numbers and people would say, oh, you're crazy. It's way higher than that. And I don't think any of us necessarily disagreed. We submitted to them, okay, well, you figure it out. But I think it's also the problem with these CPI baskets is, number one, the baskets aren't fixed. Number two, there's substitution effects that are very difficult to find. But I think that the more important point really is about direction of travel. I mean, and like, so whether is it going up and rising? Is it staying at a given level, or is it coming down and going lower? I also think it's really, really tough to, for example, there's about 330 odd million people in the US. There's about 40 million people in Canada. You're like, averages by definition destroy information. And what you're trying to do is synthesize an entire economy with trillions of transactions, literally hundreds of millions of people, into one monthly data point that is meant to be, the gospel from on high, unimpeachable, perfect data series with nothing wrong with it. I think it's ridiculous expectations. Of course, there's things that are wrong with it. Of course, there are ways to improve it and make it better. I mean, I'm looking at the trueflation now, 3%. I mean, I guess it's not unreasonable. But I think it also, I think there's all of those different things. I don't know, Keith, if you have something to add.
No, you're absolutely right. I mean, so from an investment perspective, it's just the direction and the speed that it's moving that's important. However, for anyone who was supposed to receive an increase in pay that's based on the official rate of inflation, well, there's a few grievances going on there. So if you get a 4% or 3% pay hike, whatever they paid out recently, and we all know, like, nothing has increased 3%. Like, you would take that in a day. So it is one thing. But Rich is right. It's incredibly hard to predict. And, just a few decades ago, which you guys don't remember, but, we're basically having zero prints on inflation.
Yeah,
that's where we are in the early O's. And I used to laugh because all of these.
I was there for that.
You were there, yeah. All of these financial planning software that people were using, you punch in the number, and I used to joke, well, put in zero. And they say, well, it doesn't work. Put in a negative number, because for a while, for a few quarters, we had negative inflation. There we go again, right? With really smart ways of twisting around the definition of something. But again, like, that didn't work either. But inflation, the rate of inflation, it is coming off a little bit. And I know people are pushing me into that camp, it's yes, prices are still rising, but I just look at it from what will the central bank do to react or to respond to that. So we got the Bank of Canada coming up, the Fed is coming up. I think the Fed is clearly doing another 25. They had the opportunity twice in the last 10 days.
Let's get into that.
Wait. Before, there's just one more thing I need to add. People need to understand that there isn't just one CPI and there isn't just one core. Like, there are 12 Federal Reserve branches. Each of them has a slew of PhDs trying to figure out. There's an Atlanta Sticky Fed. There's the Cleveland Median Fed. There's the Dallas Federal Reserve CPI. There's, in Canada, we have the Bank of Canada's 3 preferred measures of core, which is a factor model, a GDP model, and I always forget the other one. I think it's a median. I mean, there's dozens and dozens of already existing different measures, and I get what Trueflation is trying to do. I think it's cool. I think we want more people analyzing this data, not less. So I would never, ever discourage someone to contribute to the knowledge. But this idea that there's just one number and we all bow down to it is wrong. Sorry.
Well, imagine this, like, if you're like the inflation rate for a millennial in Toronto versus the boomer in rural Halifax. I mean, it's
boomer.
Well, that's
someone
what
say boomer.
I mean, in Japan, they have, just as a stupid example, in Japan, they have an inflation rate just for Tokyo, right? Tokyo has 30 million people. There's 120 odd million people living in Japan. Clearly, the inflation plate of someone who lives in Shibuya is going to be different than someone who lives in Osaka or whatever. So there are loads of, sorry?
That's pretty cool. I feel like
it is cool.
Like, that makes sense.
Yeah, it does make sense. I mean, I'm very, very skeptical of policymakers because I think they're politicians and I don't trust politicians. I have a lot less skepticism for a bunch of nerds sitting in a basement down somewhere, in the Dallas Fed doing econometrics. I just trust them more. Yeah, I just don't think that they're motivated to by power. I think they're motivated by stats, and I think that those people deserve a little bit more credibility. But maybe I'm naive.
So, Rich, I think you should write a narrative about all this. In your mind, it's nonfiction, but you could sell it as fiction to Hollywood because they could easily come up with some kind of story of like kid economists in their basement trying to do this or that, and then the bad guys are knocking on the door.
Well, I'm just saying we should not conflate like Powell and Yellen. and literally some guy who you've never heard of, who, maybe just moved out of his mother's basement last weekend, but has a PhD from MIT in econometrics. I mean, those are two wildly different people with wildly different motivations. And so I think sometimes people, just because, sometimes you have good data and people miss it and, disabuse that data, right? So I think that's, as we've seen over the last 2 years, people do all kinds of shit with data, right? So, but
let's not go down that rabbit
let's
hole.
move on. Let's move on.
Keith, you mentioned about the Fed. So you're in the view of the Fed is going to hike at their next meeting. I am curious your thoughts on that, expanding on that. I think there were some Fed minutes that were released. I believe it was yesterday. I think they were, what were they sort of split? It seemed like they were split 50-50 on rate hikes moving forward. So I'm kind of curious though. Why don't we dive into that a little bit more?
Yeah, I mean, so on the base of it, as an investor, you don't want to be surprised by something in the minutes when they come out. Because remember, they had the meeting over 2 days. They quickly write up the minutes for it. And by the way, the minutes for a Fed meeting is not someone in the corner, taking notes what they said. They actually go through it all in the end. Okay, let's change this word to match that word from last
Kabuki
meeting.
theater
is highly manipulated. It's what they want us to hear, right?
Yeah, absolutely. But my point is that they have, like, the announcement comes out, the statement comes out, and then they have the presser with Q&A, right? So it's 3 different things going on here. If you have the minutes coming out a month later and they're giving you information that was not discussed at all or even brought up during the real-time release of everything, then that's concerning. That's when the market blows up and they say, whoa, you gave us no idea that was happening. So when the minutes came out yesterday, there was none of that. Everything was right in line as the way it should be. And there were no real surprises there. And the gist of it is, hey, maybe we should raise rates again next month if inflation is still not where we want it to be. But if it is coming down where we want it to be, then maybe we won't raise rates. I mean, that was the gist of it. We can get into another 30-minute conversation like we did about inflation, which was bit of a snooze there, guys, but we they call it a spade a spade. But that was my and markets reacted the exact same way. But on the whole of it, in my view, the minutes still lean towards, hey, we most likely have a rate hike coming again now in a couple of weeks. What did you see, Steve?
Oh, I didn't see anything. I'm just relying on you.
Very good. Yeah, Rich, anything from you on the Fed minutes? We had the American.
I have nothing on the
GDP
Fed
as well.
minutes. For me, it was just like what happened in the UK. And the reason I think what's important in the UK is because I think there's a bit of an angle and an impact on what we saw last week. So in the UK, core inflation surprised, or I'm not sure if it's surprised, but it definitely went up after some people were expecting it to sort of continue to roll over, like basically every other country. The Europeans are lagging the US cycle, and the Canadian cycle, but basically your core inflation is sort of peaking almost everywhere. And the UK, it went up, and it went up because of services. And we've talked about services being sticky and tied to the labor market. And what was interesting is a non-trivial chunk of that was due to interest payments that are sort of feed through into the housing component of inflation. Sorry, Keith, I know this is boring you, but it relates to what we talked about last week. And that's sort of what was happening in the Canadian inflation print. But what I thought was really interesting, again, bring it back to the Fed, was that now there's loads more rate hikes priced in the UK. And now we're talking like another 50, almost 70, depending on your probability distribution, almost 75 basis points more in the UK that are just priced in. And for a country that has a lot of debt, again, at the short-term maturity, it's going to be really interesting whether or not they have sort of whether they're going to do it or not. I think that's really just another country, another central bank that's sort of in a pickle.
It's going to crush those households, man. They better start stroking some checks.
I'm going to crush them like ants. But one thing I love, because over in the UK and as well as Europe last week, there's some really great things happened, or they announced that they might happen. And I feel strongly that if it does happen there, it'll happen here. So that's what they do. They float out trial balloons. Remember, the entire West It's one, you may not think it, but they actually get together all the time and
They're in Tokyo right now.
what they want to
G7.
do. Yeah, absolutely. And sometimes there's a spat. Sometimes, the leader of Canada might tell the leader of Italy what we think of them sometimes. But the big thing that jumped out to me this week, there are three different quotes that came out of the UK and one out of Europe. So let's do the UK first. And sort of starting at the bottom level and going up higher. So first of all, in Parliament, this fella, Stephen Flynn with the Scottish National Party, they're having a big conversation about inflation. And again, this is how most governments think. Basically, the inflation crisis we have right now, his exact words were, this is a cost of greed crisis. So inflation is being caused because companies, profit seekers are being greedy, and that's why the price of everything is gone up. Of course, which I would respond to is profit-seeking entities, by definition, then are always greedy. That's what we do, and you're able to charge the maximum price possible to maximize your profit. And if you're charging too much, a competitor is going to come in and charge less and take market share away. That's just the way, it's economics 101. But the whole conversation that was taking place that day in Parliament over the UK was that it's the private sector that did this. It's not the policymakers that did it. And I think you all know how I feel. I feel very strongly, what really caused inflation here. We won't go into that here today. But the solution to this in the UK is, again, let's give out money to people who need it because of the price of things are going up. And Rich has talked about that a few times over the podcast, of course. So anyway, so what's happening there is the exact same thing that's happening over here in Canada with that. The next one that came out, which this is the one we really need to listen to. So forget about the inflation story we just did. Forget about the forget about the other one. I mean, the bank one was somewhat interesting. This is the
whole episode.
This is the one to learn. Okay, guys, fast forward to this part of the podcast. So the UK Minister of Finance, this guy Jeremy Hunt, these were his exact words. He said, while instinctively I'm not comfortable about forcing defined contribution pension plans to buy specific assets, I will not rule it out in the future. So what that means is that in the UK, again, like, this is not a backbencher, it's not someone in, the Twitter world suggesting it. This is the guy in charge of all the money in the UK. He is stating that in the future, it's likely, it's a probability the discussion will take place that they will force individual private citizens to direct their savings to buy something that the government wants you to buy, which would be, Rich?
Financial repression.
Yeah, there you go. Government debt. Looking at government debt, or they can disguise it as infrastructure or something like that. But basically, they view, and I say governments view private savings as a big pool of capital that they want to get their hands on. That's what they want to do. And they're already get their hands on it from a tax perspective once it eventually gets paid out to you and so forth. But right now they're looking at it and say, my God, we have so much debt here. If we could just tap a sliver of that money, then that would make things a lot easier. So everyone, it's happening in the UK. Back in 2012, the IMF wrote a paper about doing a 10% wealth tax on everyone, on your assets, not your investment portfolio, on assets. So we have that there. And everything happens in threes, right? No?
Yeah.
What's the
Well, I just
third?
wanted to let people know that Jeremy Hunt is a conservative party. Just so people don't think it's a left-wing, right-wing thing. Jeremy Hunt is part of the Conservative Party. Anyway, carry on.
Yeah. The Bank of England, right? The old lady, is that what they call her?
No. The Old Bailey is the law, is the courts of law.
The old lady is the court of law?
No, the Old Bailey. Or am I getting the old? Anyway, keep going. I screwed that up. I'll Google it. Keep going.
Look out your window, see what's on the building there. Anyway, guys, the Bank of England, again, they indicated, again, this is a quote. So Bailey is the head of the Bank of England, correct?
Yes.
Andrew
Okay.
Bailey, yeah.
Andrew
Yeah.
Bailey, yeah.
Yeah, not the Old Bailey, just Andrew
It
Bailey.
is the old lady. Sorry, the Bank of England is the old lady, and the
Steve
Old
is,
Bailey is the courts of law. Sorry.
Steve is shaking his head. This is the worst episode ever. It's getting better. Anyway, the Bank of England, which is equivalent to the Bank of Canada, of course, said there's a big question around bank deposits and whether the public can think or believe that their value is protected. So again, here's the leader or the head of the Bank of Canada, like explicitly saying, hey, maybe you might think your bank deposit is not safe. So what's the answer? What's the cure for that?
Central bank digital
CBDC.
currency.
Yes, there you go. And we talked about that last week, guys. So again, here's Britain. They're moving towards that same space, and so again, like try to control deposits. Government to direct where your money is going to be spent, and so forth. And then the other interesting thing that came out, Russell Napier, I think we mentioned him before, like a really sharp guy over in Scotland.
He's Canadian, isn't he?
I don't know.
I think
he's
he's
Canadian.
pretty Scottish. I think he's pretty good.
Yeah. Maybe we might have
But
his
anyway,
PR card here,
his
like
his
everybody else.
latest piece, he was talking specifically about a speech that Christine Lagarde did a few weeks ago. I think it was in the US. It was in DC that she did it. And so the whole conversation there, it was really going towards central bank digital currencies again. And again, we can't stress how important this is for everyone to understand because it is coming. And that the frustration that she was sharing was that right now, the only way for, say, the European Central Bank or Bank of Canada to try to get the private sector to spend or to invest is by controlling rates, basically. They make it cheaper, then the private sector will go out and get more capital and allocate it efficiently as possible, what they want to do. And she was voicing frustration with that because in their mind, it's not going where they thought it should go, right? See where it's going? So really, they would prefer a setup where, central banks and central bank digital currencies, when they can decide how your capital is allocated. So instead of trying to get capital and then you decide where it's going to go, you're going to go over the central bank digital currency and they say, hey, we need X million to do this, whatever Steve is going to build next over in Kitsilano. And they're going to say, well, how many units are you going to put in? They're going to decide whether you can make that allocation or not. So here we go. We have, and by the way, the last thing with Lagarde, she kept using the word Europe. And you might think, well, big deal, right? It's all one big, fantasy land area. But in that world over there, it is not. So you have the Eurozone, which is 20 countries, I believe. And then you have the European Union, which is how many now? 40?
No. It's not. It's like 27.
27? Okay.
You have to be careful because there's a European community, which includes Norway, and then they do include Switzerland. It's a whole,
Put them all in together. Yeah. So Russell was putting all of it together, basically. But she was specifically just referencing Europe for all of this. And that's done with intent as well. So the bottom line is the European project, it's clearly not working. And she's trying to get it ready to, hopefully work again. But of course, the biggest country in Europe, what happened with their economy today? What did they announce to everyone?
recession.
Recession. Yeah.
Germany, sorry. Germany is the largest country in the euro area, and it's about 25% of GDP, just so people know.
Yeah. That's it, Steve.
No, I said unfortunately slipped into recession. But Keith, to your point, Russell Napier, he's been, I don't know, pretty big driver of sort of my larger macro thesis for the last couple of years, because I think I listened to a few interviews of him sort of at the onset of the pandemic, and he kind of projected basically where this would go, which was he was kind of he was more of a deflationist, and then as the pandemic took hold, he turned to an inflationist. So he showed an ability to pivot, and basically has been calling for this financial repression, which is basically it's going to be hard to get inflation back down, and there's simply too much debt in the world.
that this debt cannot be serviced at materially higher interest rates. And so, his argument is essentially that the private sector is going to be mandated to buy government debt in order to essentially suppress the true yield on government debt.
It's amazing that like nowhere through any of these conversations is just perhaps spending less money relative to the money that you receive in taxes, e.g. running a budget surplus, or even forget surplus. I mean, that's just that's a fantasy land. I'm talking about just having a balanced budget for several years. And I mean, it's just amazing to me that there was absolutely no appetite for austerity. I also think it's
to push back on that though, right? I mean, I
Sure.
guess the other side of the argument is, well, the private sector is too indebted. It is so indebted at this point of this long-term debt super cycle that without any government spending, it's hard to derive any sort of real economic growth. I mean, that's the argument on the other side as well. So we are kind of in this, what seems to be like a bit of a doom loop almost.
I mean, maybe that's true for some countries, but the US, their household debt to GDP is at a 25-year low. In the UK, the UK non-financial corporate debt is at a 20-year low relative to GDP. I mean, we know Canada's ridiculous, but there's loads of countries. I mean, Switzerland has no debt. I mean, Greece is, I mean, for crying out loud, like Spain, which is a country that had huge amounts of debt relative to GDP, was in the hundreds, has totally lowered it down. I mean, I mean, Italy has no household debt to GDP. Household debt to GDP in Italy is 40%. Just to give you context, in Canada, it's 120%. So I think, we got to be careful about just taking everything with this one brush. That's
a good point.
But what it is, we really are, in 0809, we did reach the end of this debt super cycle, basically. And policymakers in the West, they allowed it to continue for another 10 plus years with QE and zero negative rates and all that stuff. So they didn't change anything. They just put this in place and they hoped that we could grow our way out of the problem. And all that happened was that everyone just, instead of getting your house in order, you're given the opportunity to get your house in order. On an aggregate level, it didn't happen. So governments are the ones who really just went crazy and they bored, through the roof. And so, we know that, of course, and a lot of the big think tanks around the world, they are well aware of that as well. And that's why we're hearing these conversations about, let's take, 10% of everyone's wealth, charge it as a tax. Let's go after people's pension funds and things like that. Let's have a one world order, let's eat bugs. And we laugh at that and make fun of it. However, but in some ways, there's actually some truth and realism attached to it, because they understand and appreciate that, hey, this current system is not going to last. Now, what I don't agree with is that they think they can create something better to sort of, keep it going the way they want to. And I use the word "they" a lot to this episode, by the way. However, again, I love to listen to what policymakers and decision makers are saying, and you don't have to agree or disagree with them. You just have to understand what they're telling you. And again, like this is loud and clear, everyone. We're going down a road where the governments have way too much debt. They cannot solve it. It doesn't matter.
Well, they don't want to. There's no political will to solve it, is what you mean.
Yeah, I don't think they can, though. Like even with the Americans, with this, this debt ceiling, conversation that's taken place, to put it loosely, they can't be fixed, right? There's just too much debt there. So how do you get rid of debt? You write it off. And I keep saying there's the opportunity is there. Someone is going to do it. Someone's going to say, hey, I'm not going down this other road. You simply do a debt for equity swap within your country. And whoever does it first, whoever has the courage to do it, it might seem scary at first and you might screw it up, right? Because that's what happens sometimes. But that is the road to go down, not this other road where you're just trying to make everything equal and aggregate everyone's money into this central bank digital currency. There is a way out of this. Ottawa, I know you're listening.
They're coming for the boomer's house.
Come the three of us. We'll
How about
get this
deregulation as a starting point and lowering taxes? But anyway, in order to spur growth. But Keith, I have a more serious question because I know they're never going to lower taxes. Do you make a distinction between developed markets and emerging markets? Because if a lot of this talk about really high debts to GDP from a government standpoint, from non-financial corporate standpoint, household, all that is very much a developed market issue. And what do I mean by developed markets? Japan, France, Switzerland, Belgium, Italy, UK, whatever. But if you look at the emerging market world, none of these, and yes, their economies might be small, but they have incredible population centers, right? If you look at debt to GDP ratios for India, it's 170. If you look at Russia, it's 110. You might joke about that economy, but it's an important economy to consider. Indonesia, the largest Muslim country in the world, 80% debt to GDP. Mexico's 82. And that's total debt to GDP. That includes public and private, right? Just to contextualize this, Canada has 300% debt to GDP, right? So, you've got all of the youth, the growth, and, the potential really to push the world forward is in this space that has very little debt to GDP. And so do you make a distinction personally when you're thinking about this as far as debt jubilees and the word they, et cetera, or do they not matter?
It doesn't matter. And the reason I say that, in a normal business cycle, yeah, it's important. So when it's risk on, money will flow out to those markets. And let's just say there's not a lot of regulation in some of these places. You go over there and you can make a lot of money and do a lot of good things that area. And then once things roll over, your money comes back, to the West. Because we are at the end of this long, mega rate debt cycle, the moment the next crisis begins, and it's going to happen again, guys. This is the world we're in. Money comes flooding. It just gushes out of those markets. So it doesn't matter about the demographics there, the lack of debt, the pace of GDP and economic growth, everything. When you control capital that's liquid, the moment you get a whiff that you're going to lose half your money, you move it. Like, you get the hell out.
But that's what I'm saying. No, but that's what I'm saying. That where you lose your money, where you're going to lose half your money is in the developed markets. I'm saying, won't the capital flow from the developed markets in fear of the haircut into a market that won't happen?
No, because money will flow into US dollars, because those emerging market or developing countries, they remember they're part of the global system. Yeah. And that wheel is greased with USD. So the moment all the capital is flowing into US dollars, which is, treasuries, that's what you're looking at. Yeah. The banking system doesn't work anymore. Like, everything just gets greased up. If anyone is familiar with letters of credit, to spend some time to understand what they are, and then you'll say, okay, now I get it. Now I understand that.
Okay. Did you want to get into the debt ceiling? We only got a couple more minutes left.
Into the what?
The debt ceiling. Fiasco.
The debt ceiling.
Well, Keith, because the only reason why I bring that up is you had a pretty good call 2 weeks ago now, and it's, is basically bond market volatility. Yields have spiked. Obviously, I'm getting messages every day from people sending me charts of the Canada 5-year bond yield, and mortgage rates are going back up. Inflation's sticky. Everybody's freaking out. This is the end of the world. So I'm kind of curious where you're at with that. That sort of discussion.
Yeah, so we still have that position on. After we close it, I'll share with everyone on the podcast that we're now done. Mind you, don't use that as a timing enter your exit point, because we do this once a week and you could be missing it. But with the whole debt ceiling, it's my understanding now, Tuesday will be a vote in the House, and whether they'll accept what's potentially going to be agreed to over this weekend. Again, and I don't mean a joke by saying that, but today is Thursday. Friday is the last trading day before the House vote, because Monday is Memorial Day in the US. So exchange markets are closed in the US. Futures markets are wide open, by the way. But you have that taking place. So I suspect if it is passed on Tuesday and like Sunday, late Sunday night, they come to their agreement, everything, we will get a near-term euphoria kind of rally in some sense. So whether that's in like risk on and FX markets and equities and credit and stuff like that. And if that's the case, it could be a bit of a short-lived rally, because then we got the Fed coming up right after, of course. See how the timing all works out? We got the Fed coming out, and then just say the Fed, they hike again, and then they're still going to say, they're not going to say we're done. They're going to say, hey, we're still cautious, but we're looking at stuff. And then all of a sudden, we get the fear or the risk of, recession coming along again. But the debt ceiling talks, some people say, it's political theater, and it really is. Like over this weekend, some old guy in Washington is going to come out. He looks like shit because he's been up for 5 hours working, and he's going to say, we worked hard all night and we fixed it.
Yeah, that's what he looks like after he gets up from his nap. What do you?
Yeah, I look like that a lot as well. But that's the way they have to do it, because both sides, and what I mean by that, both like the left and the right, they need to win political points with this. And they're not going to get political points from the majority of the population, because people don't care about it. They can see straight through it. But we have to go through this exercise. I think, Rich, you mentioned before as well, like longer term, it doesn't matter. Like, are they going to extend the debt ceiling? Of course they are. That's going to happen. Will the Americans default on their debt? No, of course not. Maybe something might happen technically that might look bad, but if you hold a 30-day T-bill or a 3-month or 1-year T-bill, you're getting your money back, right? You're going to get paid. So it's great fun, and Steve is up all night following this because he's really.
No,
he's
dude,
really
I sent you a chart there on the T-bill stuff. But so there was a T-bill that comes due up on June 6th. It was yielding more than 7%. At the start of the month, the yield was about 4.62. So it went from 4.6 to about 7 on T-bill maturing on June 6th. So clearly investors are, I may probably overreacting, but there's definitely, it's creating a lot of volatility in the bond market. And I think that's full
So by the way, everyone, so for that June 6th T-bill that's being priced, I'll find it. I bet you it's not available to trade. Right?
Well, that's what I was going to say. Liquidity.
It's just and really it's at this point in time, it's a 12-day, money market instrument. That's what it is. So everyone, don't go running out trying to find this magical June 6th T-bill, that was, mentioned on Twitter.
Everyone's logging into their Questrade account.
That's right.
Yeah, and they get charged 3% to buy it because it's an off-the-run issuance. No one can find it and stuff.
Anyways, well, I think that's so we'll watch for the old guys coming out of their naps here on the weekend to resolve this debt ceiling, and it's a good place to leave it for this week. So as always, we appreciate the support. All we ask that you share this episode with at least one friend or family member. Leave us a 5-star review, Spotify, Apple Podcasts, etc. Help us to continue to grow the Loonie Hour here. So appreciate your support, and we'll see you next week.